All right, everyone, we're back and welcome. My name is Chris Gervat, lead advisor at Lifeworks Advisors. Chris Patterson here, lead advisor and CPA at Lifeworks Advisors. We're here to talk to you guys about a CPA's guide to retirement tax strategies for 2022 and beyond. So get excited, right?
And beyond.
and
Galaxy
beyond.
and beyond.
And beyond, for sure. So we are live, and you just saw we did some audio changes. We're getting some feedback right there, but because we're live, there are some things that could happen during the presentation. If we do lose feed anytime, if we lose audio, if there are issues, you'll get a recorded version from us coming up later on this afternoon or this evening. On top of that, said it before, you can ask us a question. Do so by going to that lower right-hand corner of your screen, click on the button, fill out whatever you want to say to us, and click on submit and ask us a question. We'll save most of those towards the end to make sure that we get through this a little bit faster, a little bit more controlled. On top of that, if you want to book time with us, scroll down to the bottom, schedule time to talk about not just tax strategies, because again, Chris, we just talked about this. It's one of the biggest components of a great financial plan, right?
Absolutely. Because at the end of the day, any financial plan, we're worried about the overall expense load, and taxes are a key component of that. So we want to try to mitigate taxes as much as we can, which ultimately is going to drive the success or failure of a financial plan.
Yeah, I would agree. And even things like with Social Security timing, Roth Conversions, how much, when, what are we doing? Yep. It's a lot based around taxes.
Oh, absolutely.
And everyone thinks just, I have to do RMDs, it's going to be this amount. I'm going to wait till 70 Social Security and it's going to be X, right? So we hear those questions all the time, and we'll get into that more. All right. So with that, us being live too, we are talking to one of our directors of digital content over towards the right, Skylar Mills. So you might hear us mention his name. He fixed our mic just now, so go into that. So with all that being said, let's get started with, again, our tax strategy, talk about our retirement tax strategy 2022 and beyond. So let's go to our agenda right here. And Chris, outline what we're going to be talking about moving forward for the next 30 minutes or so.
Yeah, absolutely. So obviously, as Chris mentioned, we're going to get into Roth Conversions, which is a key component of most retirement plans at this point. We'll spend some time talking about donor advised funds, which quite frankly is probably one of the most underutilized strategies in a lot of financial plans. We'll also spend quite a bit of time talking about large purchases and distribution strategies, kind of multi-year distribution strategies in retirement. We'll also get into Social Security and maybe a little bit different view on Social Security in terms of how we want to approach that, from our perspective. And I think we'll have, those will be some topics that we'll be able to dig into and hopefully shed some light on things that folks either aren't aware of or just haven't approached yet.
Yeah, and I think that you hit on a lot of great things right there. And as a financial planner myself, and we work together a lot on a lot of clients, right? Is that our job is to really tie all these things together, so that those large purchases, the planning ahead. What accounts do I pull from and why? What does that mean for my taxes? What does that mean for returns? What does that mean for my kids and legacy? So some great topics right here. So with that, let's get into talking about Chris. Now, I'll let Chris talk about his journey a little bit, but he's been a great addition to our team here at Lifeworks over the last 6 months, has a ton of years of experience, 20 plus years, and we really get down to the nitty gritty with our clients and talk taxes and how that ties into your cash flows and your investment strategy. So Chris, talk about yourself, talk about your experience, and kind of how you got from being a CPA-centered person to now a CPA/financial planner.
Sure, absolutely. So it's been an interesting journey because a lot of my career has been interwoven with financial planning and being a CPA or being more of a traditional tax and accounting and audit type person. And honestly, I was just not built for audit and accounting. It's a painful existence. Yeah, I've met a few and they're great people, but it's definitely not my main focus. So, but at any rate, as a CPA, started out working with my dad, ultimately took over my dad's practice, and quickly came to realize that most clients were not getting very sound advice from their financial advisors. They really weren't getting proactive or intentional advice in terms of building out their financial plan. So as time went on, within the first 4 or 5 years of working with my dad, I realized there's a missing component here that sort of needs to be filled. And we had a unique perspective on things with clients because of our intimate knowledge of their tax situation and really their overall financial situation. So as time went on, we ended up forming our own RIA, or Registered Investment Advisory firm, and advising clients. But I also realized that it's really hard to do things by yourself.
Oh yeah.
Yep. Oh, yeah. And so the relationship with Lifeworks has been great because I've been able to continue and build on the intentionality of the financial planning, the detailed level of planning that we really want to do with clients to help them achieve their goals. And so it's been a great relationship, but it's always been, financial planning has always been kind of interwoven into everything that I've done in my career. And so this was just sort of a natural progression.
Yeah, I think you hit on the head where you're a CPA, you're a tax planner. You know that field very well. I know taxes generally. I don't know how you know it. I know different parts of an investment strategy or a financial plan that you might not know as well. Yeah. And then teams need to work together to make sure that people get what they want, because what we're seeing in our field that it's so diverse and there's so many different topics to handle. One person can't do it all. That's why the team approach that we have seen, that we think is really impactful for our clients, right?
Yep.
For sure.
Absolutely.
Yep. So we're going to get into a couple things right now and talking about these strategies. And one of the first things, Chris, that we want to cover is Roth conversions. So my question to you is this. What are some of the hiccups that you see with clients with Roth conversions, if you suggest them right away? Or what do people ask you first when thinking about Roth conversions?
Okay, so this is one of my favorite topics, and you just brought up a great point, because the most common question that we get asked, and I know you get asked this all the time,
yep.
Should I convert my traditional IRAs to a Roth IRA? Well, I have no idea.
Yeah, sure.
Right? So there is a sort of an intentional level of planning that has to happen, and we have to consider a lot of factors. So whenever we want to think about traditional IRA to Roth conversions, we have to think in terms of what's the ultimate goal. Is the ultimate goal just to convert everything? Okay, then that's pretty easy to accomplish. Or is the ultimate goal to really minimize and mitigate taxes over the life of the financial plan? And normally that's what most people are trying to accomplish. And so then there's a kind of another level of detailed planning that has to take place there. And you know this from some of the things that we've done together. We have to build out generally multiple scenarios to help clients understand, okay, should they convert now? Should they wait 5 years, 10 years? And what's the overall impact to their assets, in retirement? And I think most clients generally are not aware that they probably need to convert less of their traditional IRAs than they actually think in order to mitigate, or maybe even in some situations eliminate, the tax hit. So most common question, should I convert? My answer and your answer generally, I have no idea.
We don't know, right? The big thing with that is, okay, when's Social Security getting turned on? What is our current tax structure? How old are we? What other tax complications do we have? Do we have passive income from real estate? So it's all a factor of not so much this one silo, right? But how does this factor in to everything else to make sure we get from this point to this point the most efficiently way possible, right? All right, so talk to us about the different components of Roth that we want to do here.
So we've got to think in terms of the length of time that we have left until you have to start taking your RMDs or your required minimum distributions. It's very important, because generally we're going to build out, and not just us, but anyone should be building out a multi-year conversion strategy. We're going to look at what the current standard deduction is. It's very large in comparison to what it was, 4, 5, 6 years ago, and we have a unique opportunity now to limit the amount of conversions, leave a fair amount, whether it's 600, 700,000 in traditional IRAs, and still create tax-free distributions because of the size of the standard deduction. We can touch on that a little bit more in a second. Then we also have to factor in your tax bracket capacity. So if you're in the 24% bracket, and we'll talk about marginal rates and effective rates, but if you're in the 24% bracket, how much room do we have left in that bracket when we convert? Are we going to bump you into that 32% bracket? Obviously, we want to try to avoid that. So how much room do we have? And then kind of an often overlooked aspect of this is all of these accounts, hopefully, are going to grow. So we have to factor that into the equation in terms of the multi-year approach and how much we're ultimately going to leave in traditional IRA assets. So that growth has to be factored into any conversion strategy.
Yeah, and one thing we see a lot too, Chris, with people that work together with and everyone else at Lifeworks is, hey, I'm going to pay the same amount of taxes over here, but because I'm not taking this higher level of RMD, my portfolio has a better chance of growing because my tax hit is going to be less over time. So it's not the same for everybody. It's not cookie cutter. Everyone's drafted, but I think a big component is we're looking at year 2022 and beyond, but we make good choices as of what we know for this year, and tax laws might change, but we're ready to adapt every year, right? To make changes in real time.
Absolutely. And another factor that we didn't really mention here, but is every bit as important, is what's the legacy plan? How much are you planning to leave to children, to grandchildren, and what would you like to leave those assets in? Some of our clients we've seen convert into Roth IRAs, and they never have any intention of touching the Roth IRA. So it's part of their legacy plan. So that's another big factor that's included in this.
100%. So let's go over an example right now of kind of what we look through, and example of a conversion strategy with different levels of assets needed, ages, things like that. So Chris, talk us through this example we have right
Sure, absolutely. So obviously, full disclosure, it's kind of a crafted scenario, but it's also, it's pretty realistic based on a lot of things that we see. So current age of the client is 62. The retirement income need obviously is 100,000. Current assets, traditional IRAs of about 1.2 million. There's a taxable brokerage account of about 800,000. We've got about 50,000 in expected Social Security income, and that's for both spouses combined. Okay, so what we'll see here in our chart or in this graph, you'll see your beginning values, your account growth, the recommended conversion amounts, and then the ending value. So I won't go through line by line here because you can kind of pick up on the concept. But the reason I say this is sort of a crafted strategy is that ending value is $640,969. So the reality is when we get to those levels on the traditional IRAs, now, because, and we'll look at this in the next slide, but when we start to have our RMDs come out, our required minimum distributions, we're below, because we're at roughly 23,000 in the RMD, we're below that standard deduction amount. So we're pulling those traditional IRA assets tax-free, depending on other income. Now, there is no pension in here, and pensions can throw a little bit of a wrench in this type of plan. But that said, now we've got that traditional IRA asset that has a very limited, essentially no tax associated with it. Yeah.
Yeah, and then one component too to talk, Chris, as we go to the next slide, Skylar, for talking through this more is people forget or don't know that, hey, is my RMD going to be this certain amount per year? No, it actually increases each and every year based upon your life expectancy, right?
Yeah.
So your actuarial tables will determine, so the first year it's divided by, I think, 27.4, right? Or something like that. And then the number keeps getting drawn down to a higher denominator, which means more money that you have to pay taxes on. So your taxes, if you don't control this well, might go up as you get older.
And
right?
that's a great point. You know, as much as I hate to give you credit for anything, that's a pretty solid point, because the reality is your RMDs are going to go up year over year. The account value, again, should be going up, not necessarily year over year because market fluctuations, but over time should go up. So that's there's so much that goes into Roth conversion planning that when we get asked that question, should I convert my Roth IRA? It's like, oh man, that's a really hard question to answer because we've got to dig into the details.
Yeah.
Now,
let's talk about this.
Yeah. So as we look at this next slide, so this is essentially the other side of the equation here. So we see our Roth IRA, the beginning balance obviously is zero. We're converting 50,000 in that first year. We've got again, well, we didn't mention on the other one, but 7% projected growth in the account. So 3,500 in account growth, ending balance of 53.5. So you can see, again, as we convert more and as this account continues to grow, at the end of this 10-year window, our Roth IRA now has about 1.8 million in that account. Now, the interesting thing is that when we look at the income and the tax analysis, we've got the Social Security income of 50,000. We've got the traditional IRA RMDs of 23,393. That's just the first year RMD, as you mentioned. It's going to creep up a little bit each year. The taxable brokerage account, we're pulling $27,000 for that. Now, the most common question I get when I show this is, well, why don't you just pull the assets out of the IRA? Well, there's really two reasons for that here. Number one, we want to show some tax being paid here because a lot of people that see these webinars think, well, I'm not going to pay zero tax. That's not realistic. So, but the other aspect of this is we don't know the legacy plan for this client. So I'm making an assumption here that they want to leave the Roth IRA alone so that they can eventually leave those assets to children or grandchildren. Always have that option to pull funds from the Roth IRA, and of course it would be tax-free in that scenario.
Yep, yeah, for sure. So you talked about this scenario. So we did our conversions over a 10-year window, correct? Right, and then we end up around 640-ish, I believe, was the number. And now that's based upon us taking the RMD at 72 of 23,000 with our standard deduction, everything else changes it. So with our income that we need to live the lifestyle that we want, you're saying that our effective tax rate in this situation is 2.86 with proper planning.
Correct.
So this is where, let's bring a question on here. People always say, oh, my tax rate is this, 24%, 28%. it's the argument of effective and marginal tax
Yeah.
rate. So talk a little bit about how people get confused with this and things that we do for when we're looking at tax planning, that yes, we're hitting 24, but your actual effective tax rate is 16. Talk about that a little bit for us.
Yeah. So there's any time that we prepare a tax return, we're generally going to talk with the client about, okay, this was your margin rate, this was your effective rate. The easiest way that I can explain it is gross versus net, and think of it in terms of a paycheck. So gross paycheck, obviously you're not walking away with all that money. You've got some taxes that you pay, other things, and then your net paycheck is actually what you're getting, right? So same thing with marginal rates versus effective rates. Your marginal rate is essentially your gross tax rate, kind of before any deductions get factored in. Okay, and then your effective rate, that's really based on your taxable income, which that's where the deductions and other things get factored in. So typically your effective rate is going to be lower than your marginal rate, and that's like the real dollars that you're paying. So anytime, and because of all the work that we've done together, but anytime we talk with a client and we're doing any tax planning, we're always looking at the effective rate, what you're actually paying, not just your marginal rate, which is important for planning, but it doesn't really drive everything that we do.
Yeah, and we had a client recently, right, and they're trying to buy a new house, right? They have an RV they want to buy as well, and then on top of that, they're like, I really want to keep this cash over here to purchase those things, so I don't want to live off of that. How is my tax situation looking if I live off my IRA? And at first we're like, we'd rather you not, but let's dig into it first.
Right.
And we dig into the situation, we say, okay, we keep your effective tax rate at X, and this is doable. Let's do this for a year before pension kicks in, before X kicks in, right?
Yeah.
So to us, it's always about digging to make sure it's not just, we think this is a good idea. Let's really see if it's a good idea for this year or not, because we can project out, again, 10, 15 years down the line for all these tax situations, but what's real right now and how are we adapting? So real life things to make it so the distributions are right, and that's probably our next topic we talk about, correct, I believe?
It is. And just one other quick point here in terms of the Roth IRA, if the income need was $100,000, right? Well, we solved that income need with the Social Security, the traditional IRA, and that taxable brokerage account. You've still got a $1.8 million asset sitting there, but if you chose to pull out 2, 3, 4%, you're probably going to be just fine pulling additional funds. So you could have a pretty comfortable retirement with that type of Roth conversion strategy in place.
Yeah, I think that's a big point of it is we're preparing for what you can do, not what you can't, right? So with tax planning, it's like we do this, we can still do this and spend this money buying that RV, buying that house, or giving money to that charity, donor advised funds talking about now, or anything else. So it's not restrictive, it's more so giving you the ability to make better decisions based upon good facts, right?
Yeah, absolutely.
And that's it. So this is, and you have it written right here, Chris, probably one of the biggest things that's not really used, and I think is a great double-edged sword to give to people. So talk to us about donor advised funds and why you think they're so impactful for people.
Well, again, we'll go back to the standard deduction. Because the standard deduction is so large now, a lot of folks who are fairly charitable, whether it's $5,000, $10,000, $15,000 a year, what we generally see is most of those individuals probably have a paid-for home, right? So there's no mortgage interest, there's no real estate taxes. So they're missing out on any tax benefit for those charitable contributions. So the reason donor advised funds have really kind of gained steam is because the standard deduction has increased so much that now we have the ability to essentially expedite annual giving into a single year, create the deductibility for that giving. And the interesting thing is, because we've got some flexibility in timing, we can generally marry that expedited giving with an income event, whether it's a Roth conversion, or maybe there's a stock plan that a client has access to that they've got to pay out in a particular year. So the donor advised funds create a tremendous amount of flexibility from a planning perspective, because now you've got the ability. So if, a common example is, well, we've got a client who's giving $10,000 per year, they're taking the standard deduction, but they've got, enough in cash to where they could expedite 5 or 6 years into 1 year, right? So now that $10,000, it's a $50,000 to $60,000 contribution into the donor advised fund, and they have deductibility of those contributions because it's obviously greater than what the standard deduction would be. And again, we can marry that with an income event if we need to.
Yeah, Chris, I think we talked about in the next slide, and it's almost, just giving a straight donation as opposed to putting into the donor advised fund, right? And it goes along with, understanding the principles of this donor advised fund and what you can do and the flexibilities involved with, hey, I'm putting in a higher amount this year. Does that mean I have to give to this charity in this year? Right. Why is it better, and where does it provide a family?
Well, the beauty of the donor advised fund, and of course you know this obviously, but the beauty of the donor advised fund is that you can make the contribution, but there is no requirement in the current year to distribute all of those assets out. So you can almost, in essence, kind of create, sort of a little mini endowment fund within your family. And where I see this coming into play more often than not is, you know as well as I do, life happens fast.
Sure.
And so for whatever reason, there may be a particular charity that kind of forms a special place in your heart because of maybe some life circumstances. So the beauty of the donor advised fund, if you put $50,000 or $60,000 into the fund, you get that deduction currently, but you don't have to distribute those funds currently. And that account could grow because it can be invested and allocated. So you could, in theory, donate those funds. I believe, if memory serves, I believe it's a 5-year window on the cash having to come out. So you have some time that can be left in. But the point I'm trying to make is maybe something happens in year 2 or year 3, and you think, man, I'm really grateful for this charity. Now you've got this fund in place where you could put some funds their way to help them continue to achieve their goals and benefit other people. Yeah.
I think one of the better things too about them is the flexibility into who you can donate to. If you have an idea of this one thing you grew that you love, but all of a sudden life changed again, and now you want to donate to X, Y, and Z, it doesn't make you say, I have to sequester this and put it into and give it to this charity, give it to this one, and this one.
Right.
And that's one of the great parts about it is it doesn't lock you into who you give it to, and you can choose over the course of time of who you want to donate to, right?
Yeah, and I think one of the reasons it's an underutilized tool is most people don't understand how they get set up. Where do they go to do it? What are fees associated with it? So just as a real quick kind of high level, you can go to just about any brokerage firm, whether it's Fidelity, TD Ameritrade, Schwab, pretty much all of them will set up the donor advised fund. So you can go and do that, and it can be set up kind of as an account within your profile with that particular brokerage firm. And then again, once it's there, the brokerage firm is kind of handling a lot of things behind the scenes in terms of the paperwork and documentation that is required to set that up. But then those contributions can be made, and you're kind of off and running. So it's not as complex or as tedious as some people may think. And again, I think that's part of the reason it's a little bit underutilized.
For sure, no question. So we're going to ask some more. I'm guessing there's going to be more questions about that moving forward. On the next slide, though, we're talking about something that we always come across together, right? And it has to do in regards to this creating a multi-year distribution plan. And it's just, to us and to me, for large purchases, for giving, for experiences, for travel, what account do I pull from and why? When do I change that? Do I keep this going in this form, or do I pull from my Roth or pull from this? And I think that's an ever-changing, living, breathing thing that is very tax-focused of how to do this with distribution strategies to live off your money. Because again, you have your assets, you've turned off the faucet, you're retired now, and all of a sudden you're paying yourself. The first question we get asked from clients is, how does this work? How do I pay myself? And how does this all tie into my taxes? So Chris, go into this a little bit.
Yeah, and this is an interesting one to me because there's the devil is in the details. And when it comes to this, I think most clients, they're in retirement, they want to relax, they want to enjoy themselves, they don't want to be burdened with, oh man, now I got to do all of this extra work to figure out where to pull money from, how much is it going to cost. And I think a lot of times clients sort of just take the easy way out because it's easy, and they don't have to really think about it. So the most common thing that we hear is, well, I'm just going to pull the money from my IRA. I'll have them withhold the tax, and I don't have to think about it or worry about it. Well, the problem that we see with that approach is, especially if a client has some taxable accounts in place, or maybe they've got some cash in place, again, marginal rate versus effective rate, we want to dig into And this is why, from my perspective, and I know from yours, this is why financial planning is kind of a fun, rewarding type of thing, because we can really get into that and we can solve a problem for a client that they either couldn't or didn't want to solve for themselves. And I totally get it. Like, you know, I can't fix my kitchen sink, right? It doesn't matter how hard I try to figure it out. But the point I'm trying to make is, instead of pulling money from a traditional IRA, let's look at what accounts you have in place. Let's look at what cash you have in place. Because again, creating, and we do this all the time, creating a 2, 3, 4 year distribution strategy where we look at the actual amount of money that's coming out of different accounts. And more often than not, we're able to utilize taxable brokerage accounts, or maybe there's some type of stock purchase plan, or there's cash on hand, and we can kind of protect the IRA assets. Maybe they still need to pull some from that, but instead of paying, you know, $20,000 in tax overall, maybe we can get them to $10,000 or $12,000 in tax that's paid. And again, that savings just makes the likelihood that their financial plan is going to succeed that much greater.
Yeah, and I think you're hitting the nail on the head there too with, you know, you're a CPA before, right? A lot of CPAs and tax preparers don't look 3 years ahead for preparing for distributions from accounts. They look at, here's what you took for this, took out of your IRA, you had an RMD, here are your taxes, here's what you owe. The flip side, and what you've been doing for the last 10 plus years plus, and what we do at Lifeworks as well, is looking ahead to plan for these things.
Right.
And being proactive with what we do now is going to affect us the year, next year and the year after. Right. And to us, I think that is a component that a lot of clients that we deal with are not used to seeing. They're used to seeing their investment strategy being done and invest 60-40 and paying taxes, but not diving into what account do I pull from and why? How am I doing this and why, right?
Well, and see, and you hit on a funny thing, because we're here talking about financial plans and taxes. We haven't talked once at all about investments, right? So the reality is that, again, most clients just don't want to have to deal with this level of detail. And I totally understand.
It's complicated, right?
Right. And you just retired. It's like, I want to relax, enjoy myself, go to the beach, play golf, travel. Totally get it. But the point, if we get any point across when it comes to creating multi-year distribution plans, is look at what you have available to you and determine the most efficient means with which to pull money out of the accounts. That's what you're trying to accomplish at the end of the day. And when we say most efficient, we're obviously talking about reducing overall taxes.
100%.
Yeah.
100%.
Yeah.
So we can answer more questions about that, but that is a massive component of what we do at Lifeworks, and what great, good financial planners should do across the board is that multi-year approach to distributions and taxes. So the next one is a funny one we get asked all the time, especially like when we first have a new client come on. When should I take Social Security? And our immediate answer is, I don't know.
So, and that is generally our answer. I don't know. Let's kind of dig into it. I think, I told my dad when I started in the accounting world, I said within about a month I had figured out the answer to every tax and accounting question. It depends.
Yeah.
Right. And it's not a whole lot different in financial planning. So when should I take Social Security? Well, it depends. And we look at it a little bit differently. And we don't look at it, in a silo. So what I mean by that is Social Security is a component of your retirement plan, of your financial plan, right? Well, the mistake that we see clients and advisors alike make is the concept of maximizing Social Security income, but not maximizing the retirement or the financial plan.
Exactly.
Right? So when we do our planning with clients, or when we look at things with clients, yes, we want to help maximize the Social Security income, but we're much more concerned with the overall success of the plan and the overall plan assets. So if there's a strategy to take Social Security at 62, and that helps to drive the plan assets, let's say at age 90, instead of 2 million, they're 2.5 million, then that's probably a better approach than just simply, well, I'm going to take it at 62 because now my Social Security income is bigger than if I waited till 65. Because that's just looking at one component.
Exactly.
And so that's why when we talk with clients, we kind of say we look at it from a little bit different approach and trying to maximize the overall assets. And that's the key component, because really, when we dig into the financial plan, we have to factor in all of the different components, all of the different metrics that go into that plan.
Well, I think that's it, right? It's Social Security. Okay, what are the conversions? What are we doing, and how often, how much, when? What accounts are we pulling from? So if I do Social Security now, what does that mean for my effective versus marginal tax rate?
Right.
And how do I blend all these strategies together to make sure it's the best for me and my family, and all for my goals, right? So it's everyone asks those silo questions all the time,
Right.
all the time. Social Security, conversions,
Right.
it depends. It depends is the answer until we start digging into the details, and the devil's in the details of really figuring out, presenting people with the scenarios that helps them make wise decisions. At the end of the day, there's a quantitative part, right? There's the numbers. And there's a qualitative part. Like for our client that said, I don't want to spend this money, is there a better way or can this work? And we make it work. And it has to be efficient, and it has to make sense for how they want to live their life, right?
Absolutely.
So Chris, lots of components here we talked about. We talked about Roth conversion strategies. We talked about Social Security. We talked about donor advised funds. Okay, we talked about distributions from accounts. So I think the offer is this. The offer is, Scott, go to the next page, please. And it's a free personalized tax strategy with Chris and our team. And Chris said it before, where we know what we know. He's a CPA, financial planner. We have investment team members, and we come together as a team to help out our clients. But the whole point is, if you feel like right now that you don't have this buttoned up tax strategy that is part of your financial plan that is living and breathing, if you feel that your Social Security and your conversions and your healthcare costs, did you retire at 60 and you have to have some kind of Medigap coverage to cover till 65? What does that mean for your income? If you take out too much money, do you pay too much in taxes? Can we subsidize income, right? Things like that. Right?
And I think one of the things, and we had this conversation yesterday, the reality is that for clients, financial plans, retirement plans, whatever you want to call them, if they're done correctly, meaning all components are factored in, they're stress tested, you've got multiple scenarios that have been worked through, they're very freeing for clients, because now you've got this thing, right, that gives you the knowledge and the information that you need to say, you know what, I had planned on spending $30,000 on travel in retirement, but based on the plan, I can actually spend $40,000, right? And I think, and I'm not going to say that's always the case.
Sure. That'd be awesome, wouldn't it?
Right. But I think more often than not, most clients have accumulated assets very diligently without much thought towards how am I going to spend these assets? How am I going to improve my life in retirement? And there's kind of a fear factor that gets played in that limits clients in retirement.
Yeah, I think it's that risk of a mistake, right? Of did I do this right? Am I really doing these strategies to the best to help my family out? And that's what we're here to meet with, right? So if you feel that maybe your strategies aren't the best or not lined up, if you scroll down to the bottom, you can pick time on a schedule with Chris Patterson. See if a time works for you. It's a 60-minute session to talk about your current tax strategies and get analysis on some points that you could be missing. And Chris, to be honest, you're not going to solve issues on day one because you can't. Remember, people are going to ask, when should I take Social Security? When should I do this conversion? We're going to say it depends. And Lifeworks, and you as well, since before you came to Lifeworks, it takes several meetings for us to get a good grasp of all of your moving pieces to start coming up with those strategies to make sure that they all make sense and it's a wise decision we're helping you with, right?
Yeah, absolutely. And it's very much a back and forth, not too unlike this, right? So there's a lot of conversations that get had. There's a lot of information and sometimes that information kind of trickles out. Oh, well, we didn't talk about this on the last, last session. And those things have to be addressed. And eventually, we typically come to a good place with a client where now we know what they're going to pay in taxes, in year 2, 3, 4, 5, and beyond, in retirement. Now we know how they're going to handle, that potential long-term care event or how they're going to give to charity. We've got all of that baked in to the plan. And again, it's very freeing for clients to get to experience that. Yeah,
and to say this too with our offer, and if you decide to become a client, and just quickly, here's how it works. We're a financial planning first firm, right? We have 4 to 6 meetings when you first come on board to really make sure that we're giving you value through this in-depth financial planning, which is tax strategy heavy, right? To make sure that we're doing distributions right, conversion strategies right, timing of trips and everything else. So we have to show you value up front with how deep we're digging in and what we're doing for you to give you that clarity to make those choices, right?
Absolutely.
Yeah,
I mean,
yeah.
that's the only way that this can get done.
Yeah.
That's the only way it can, and the plan comes first.
Exactly, and we're a fee for planning firm, right? So we're charging you for this, so we're going to show you value. If you hear from a firm that says, give us your assets first, and then we'll see what we do for you, and planning is free. Chris, how much tax work are they going to do for that?
Zero.
Do they have a CPA on staff that's directly related to them, or probably someone they might call in, but it's not as personalized, right?
No, it's definitely not as personalized, and quite frankly, not as effective.
Correct. So with that, we'll go back to this offer in a second. Let's answer some questions now. Let's see what
Absolutely.
comes up here. So Chris, read these off
All right.
and see what we have here.
Let's do it. All right. So my wife and I are both over 67 years old. I make $2,100 a month in Social Security, and my wife makes $1,200 in Social Security. If I die, will my wife continue to get $3,300 per month? So this is really, kind of driving towards a spousal benefit. Yep. And I believe, correct me if I'm wrong, I believe once that spouse has passed away, that spousal benefit, I believe they still have access to that? Or?
They have. It's the higher of the two.
Okay.
Right. So if the person that makes $2,100, you will lose that $1,200 for your wife. So her benefit would be $2,100. So it's always the higher of the two. Whoever passes first will always get $2,100. So there is a loss of Social Security income that comes if you do delay that. So that's a financial planning question, not so much a tax question. So that's why I feel with that one.
I appreciate that.
You're welcome. Next question here. All right, so how do you access the several $100,000 in increased value of your property when a fixed income and not meeting the 50% requirement needed for refinance with cash out?
Yeah, and I think really what this question I think is kind of driving towards is the possibility of a reverse mortgage here. If if by chance you're not able to qualify for the refi with the cash out, I think you're going to be kind of limited possibly to the reverse mortgage. Any thoughts on that?
Yeah, and I think that's part of one of our things we look at when we do some in-depth planning is, we have this cash, we have this equity in our real estate. Do we access this and does it make sense? And for us, a reverse mortgage is something we look at. It's one of the last things we look at to make sure because, again, you're giving up equity, you're giving up that part of your house. If it's not part of your legacy account anymore, it's to the banks now, right? But you might need that to live off of. So that can be done, and that's probably a way of doing it, but is there a more efficient way of looking at it? But it might not be. So if you book time with us, we can definitely talk more about that in details if it makes sense.
Chris Gervais, can you go over how to ask a question?
Yes, if you want to ask a question, again, go down to the bottom of your screen, go to the right-hand corner. There should be a little box with little lines for text through it, right? So go onto that, pop that up, ask your question, hit that little arrow in the right-hand corner, and that will ask a question.
All right. In what order would you suggest withdrawing funds from investments when needed? IRAs for RMDs, direct charitable donations, funds with higher capital gains, funds with higher balances.
So what did we talk about before? What's that word?
Yep. Well, it's a multi-year distribution strategy.
Yep, it depends, right? Yeah.
Well, right, it depends, So this question is, in what order would you suggest withdrawing funds from investments? It depends. Really hard to answer that question without knowing the makeup of all of the different investments and all of the accounts that you have in place.
Yeah. How much capital gains? How much do you have in the Roth? How much do you have over here? What is your effective and marginal going to be? X, Y, Z. And it goes down to that really effective tax planning with seeing if we pull from here, what happens? Pull from here, what happens, right? And keep adjusting. And then we say, well, it might be multiple accounts too. It might just be one. It's going to be a draw from this account or this account or that one, right?
Yeah, absolutely.
All right. So what's the next question we have here, Skylar? Yeah, there you go.
All right. This month I'm having a large deposit of funds into my 401k due to required liquidation of my ESOP, employee stock option plan. As a result of my retirement, I am looking for alternative investments for some / all that money that has potential for growth with reasonable liquidity. All of this money is pre-tax, so I am concerned about the tax implications of how these funds would be invested.
The question's beneath that, right?
Oh, I'm sorry.
What if? Yeah, what would you do? There you go.
What if?
Is that the question?
No, that's
No.
That's just a statement. Okay. Gotcha. Separate. Okay.
Yeah. Okay. So more of a statement. I think.
Yep, and I guess it depends on how much you're getting in there, what that means for long term, and how that's going to operate with the ESOP, right? If you're getting a huge payout into the pre-tax side of things, is hey, can you start stacking? If you're still working, are they still working? They are, right? Yes. So do you have the 401k component that is a Roth side or non-Roth side that you can put more money into? How does that work? So
now,
it gets a little more complicated.
It does get more complicated, and I will say that sort of also drives to the possibility of some net unrealized appreciation
Yep.
within that account. There are some unique kind of tax strategies associated with that. So that might be something that's worth a little bit more exploration just to figure out if that applies, because there can be some pretty significant tax savings when it comes to the NUA or the net unrealized appreciation.
Sure.
But yeah, so something to keep in mind there.
But something we look at, no
Yeah,
question.
absolutely.
Yep.
Yep.
Sure.
Yep.
So,
All right, one of our biggest challenges nearing retirement and retiring early, 58, that's awesome, is finding an advisor that can really get specific about taxes versus saying you'll have to consult with your CPA. It sounds like you guys might be a little different in that regard. So the simple answers are yes, absolutely. That is, as far as my background being a CPA, that is sort of why I evolved into financial planning, because I felt like most of the advisors that I had to refer out to were really struggling with the tax aspect of things. And they would end up just kind of referring them back to me. And then I'd be answering tax questions or trying to solve a tax equation without knowing what the financial plan looked like. And they really go hand in hand. Yeah.
and I really think that's where Lifeworks has kind of separated itself from a lot of financial firms. Is we've heard that a lot from clients is, well, I have to go here to get that done, or I have to go here to get that done. We are a group of people that have different skill sets,
Right.
and we came together with knowledge of taxes, of making sure the insurance is right, making sure that your state and your legacy is correct, get your trust and will done the right way. And we do most of the stuff in-house to make sure that you don't have to go here, 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 and here to service you. So we have a 6-person investment team that does a fantastic job with really aligning all these strategies you're talking about with financial planning to your investment strategy. Totally different conversation, but it's the team approach that I think is really important for clients, because one person can't do it all. You don't look.
Right.
Did Chris know that question of Social Security? No, he didn't.
Right.
Half the questions about taxes, I don't know the full answers to.
Yeah.
With everything else. So the whole point is we have a team of people that come together to get the answers for our clients.
Well, and I think what's funny here too, in regards to that question, is the way that we operate is, it's almost kind of a trust but verify type of scenario. So a lot of times we'll look through a financial plan via our planning software, but then ultimately, if it's tax related, I'll typically take that plan and test it via an actual tax return for the client, so that we can kind of confirm that the tax treatment is correct within the plan. Because if it's not, then it's really hard. We can't move forward. So that's kind of the extra layer of testing that we do within plans.
Yeah, 100%. Yeah, we don't always just rely on the software only. We test it in through our own cash flow methods and taxes, which is crucial.
What if you do not want investments at this time, as they are all tied to the stock market, and we know that's going to crash very soon? So
Let's hope not.
Depends on the hour. His is not like any other time in history, and a Roth account holds your money for years. So I guess the general answer to that question, if you don't want investments at this time, we are a planning firm, and as I mentioned earlier, the plan comes first. So if there are concerns or things that need to be addressed from an overall planning perspective, then that's exactly what we do all day, every day. We haven't talked about investments once on this webinar, and while investments are important within a plan, the plan comes first. Hopefully that answers that question.
Yeah, I think the biggest thing is our goal as a firm is to make sure that our clients have predictable income in retirement, right?
Yeah.
Predictable income in retirement, and our investment strategies help that and align this up. We'll keep that a separate conversation, but we're also firm believers that we don't believe that all of your assets should be tied to the market. It's important to have different things of real estate, of precious metals, or whatever it may be that makes sense for you to be diversified, to take away some of the market risk, right? Because everything in the market right now is correlated. I don't want to keep this more towards taxes, but whole point is we believe you, and that question, we don't think it all should be tied to the market. And there are better ways to make sure that you guys live the life that you want. We help with it, with the tax strategies, and we push forward.
Yep.
So, want to answer this question first, Skyler? I will get.
We're about halfway through.
Halfway through?
Yeah.
Okay.
Okay.
Yep.
All right.
So it's one more time though. So guys, again, we're answering more questions. Feel free to keep staying on as we're answering these questions. But if you want to book some time with us to go more into detail about your tax situations, about your financial plan, just scroll down to the bottom. There's our schedule there. It goes directly to Chris Patterson's email account and his calendar. You book time with him, and he might pull me into a meeting with more financial planning. He might pull our investment team in. So it's all about what's most important first. What are we trying to accomplish for you? and how to figure out, are my tax strategies and Social Security timing and my distributions right? And do I have any thought into this, or am I just saying, RMDs are coming, I'm just going to wait. So let's keep going.
Okay. All right. Do you have a recommended blend of Roth versus traditional? Right now I have about 70% Roth. I figure it's okay to have some traditional, can offset against deduction. Not sure how that may interplay with Social Security. May look to convert if the correction turns into a bear. I'm not sure how much. So I love this question because from a general perspective, my recommendation is to keep enough in the traditional IRA to minimize the tax hit and convert the remainder into the Roth IRA. And to the kind of second part of that question, how does that interplay with Social Security? Well, if you're pulling funds, whether it be from a traditional IRA, that those distributions are under the standard deduction, or you're pulling from the Roth IRA, then you are limiting, hopefully eliminating, the tax hit on your Social Security. So that's how those kind of interplay. Do I have a general recommendation on percentages? No, not really.
Everybody's different.
Right.
Everybody's different.
Right.
Yep.
Yep. Absolutely. I heard Chris talk in a webinar within the last couple of weeks. I'm going to assume that's you. I heard Chris talk in a webinar within the last couple of weeks about you guys doing planning only. Is that a viable strategy for people?
Yeah, I guess I can answer this. And we do have a lot of planning only clients, but a lot of them are people that own their own businesses and have a lot of their assets tied up to their business, right? So other equities tied to this or investing in this, either trying to sell it or build it up, and they're in their 40s or 50s and they're not done yet. So do we have a lot of clients like this? We have a bunch. But a lot of our clients are financial planning clients and investment clients. It doesn't mean we have to be, and we're going to advise our clients on everything. Our job is to be holistic, right? Our job is to make sure we're not just advising you on what, if you were to become an investment client of ours, what you have here. It's about your overall picture. Can we be as proactive if things start going a different direction? Not as much, but the whole point is yes, we do have them. They are here, but it's more so those that are probably the younger clients, our older clients that are, I'd say 50, 60, 70. We help do both, and it's not like we have to have all your assets. But again, I kind of want to keep this conversation more towards this. So yes, we have planning only. It works out great, and it's mostly geared towards those that own their businesses or a little bit younger.
Yeah, absolutely.
Yep.
Yep. Let's see. I have done Roth conversions for the last couple of years, always been able to stay within the lowest tax bracket. That's great. I recently retired, and I'm wondering if I should increase my conversion, which would result in going to a higher tax bracket. So yeah, this is a great question.
Yeah.
And this really drives to some of those things that we talked about earlier. So the simple answer is yes, I would consider that, even if it puts you in a higher tax bracket, if that drives towards the success of the plan overall. Sure. So I keep coming back to it. The plan comes first, and that really is true in a lot of different aspects of what we do. If you do those conversions, you get bumped into a slightly higher bracket, but the life of your assets or the value of your assets are greater at the end of the plan, then it probably is going to make sense.
Correct. Yep.
Right? Yeah.
Correct. Yeah.
Okay. All right. With conversion of 150,000 RMD, required minimum distribution of 24,000 and Social Security of 50,000, shouldn't you subtract the additional Medicare cost from the gross? So the simple answer is probably yes, but every situation is a little bit different. So we have to be kind of generic in general in a lot of the things that we put together. But I agree with the question, and I'd be happy to dig in that a little bit further if you'd like to. Yep.
I think they're referring back to the example we had, right?
Yep.
Yeah. So we're doing it as a general example, guys. We weren't saying this is the exact way of doing it, just that. So
yeah, the example that we put together was just to kind of drive a point home in terms of things you should consider. But no, I thought it was a great question, very very well thought out. What if you are at less than 41,000 income amount for no taxes in retirement, and what is the next step up in percentage of taxes? I'm not sure I follow the question.
I think they're asking for brackets maybe of where they're at, and the next where.
If you're at less than 41K income amount for no. If the question is specific to brackets, I never can remember the brackets off the top of my head. But if it's something that you would like to just see the brackets, we can certainly get the brackets out to you. That's no problem. Any comment on withdrawal strategy from a federal thrift savings plan all pre-tax.
Yeah, I mean, a TSP account, it works just as if a 401k plan, right?
Yeah.
So it's not much different. We have a lot of clients that are, federal agents, marshals, U.S. marshals, things of that nature. So it's pretty much the same as we do with any other plan of how we would structure it, right? So it's going to depend on a lot of things for distributions and conversion strategies of what makes the most sense, where are we pulling from. So yeah, TSP, we've dealt with a lot of government employees over time that have pensions, that have their FERS, that have supplemental FERS, that retire early, and it's all tied into all of those things with income. So great thing about that too is step up value or cost of living adjustments for their pensions too they have. So yes, we deal with that, but again, going back to what Chris said before, it depends. It depends on how we withdraw distributions and what makes the most sense for the client, right?
Because ultimately you've got to, again, to Chris's point and some of the things we talked about earlier, you've got to make a determination of where and when funds are going to come out of different types of accounts. So if the only retirement account is the TSP, well, then you don't have any other option. You've got to pull from that. And so then it becomes less of a tax planning exercise and just more of an overall financial planning exercise. And the question there kind of becomes, well, should I leave it in the TSP? Should I look at moving that, into an IRA? What are the returns going to look like? And that becomes a little bit more of an investment-driven question. Gave a few shares of stock to my minor grandchild. He sold at a profit of $800. They earned $200 in dividends. Does the minor owe any federal income tax?
Are they working? Right, that's the question, right?
Yeah.
So are they working?
Well,
Do they have income? That's part of it.
Right, that's definitely part of it. The simple answer to that is yes, probably. There are probably a few more details that I would need to answer that intelligently, but the simple answer is yeah, they probably will owe some income tax.
And more so linked to the dividend income as opposed to the capital gains, because if you're under certain thresholds of income, if their income is below $40,000 as an individual, I believe you owe $0 in capital gains taxes. But there's state tax also linked to that, right? So we're talking Fed, but it gets a little more complicated with depends, all right? But they might, yes.
Is it true that beneficiaries of Roth IRAs have to withdraw those funds within 10 years? So that may be a tax burden for them, but they get the same tax-free benefit over those 10 years. So what we're really talking about is an inherited Roth IRA. The simple answer is yes, they've got to pull it out within that 10-year window. But because it is a Roth, again, this kind of drives to some of the legacy planning that we had talked about. Because it is within that Roth, you're going to have some of the tax-free advantages associated with that. So.
Yeah, but when you pull it out, though, for those 10 years, it is tax-free. The minute you put it into something else, like a taxable account, then it becomes capital gains or that. But yes, it has to leave that distinguishable Roth account, the inherited IRA, inherited Roth IRA, into something else. But until that time, that's going to grow tax-free until they want to withdraw that and put it somewhere else. When they do withdraw that and move it, your cost basis at that time will be zero.
Correct.
Right? So only when you move it to the other account is when it starts affecting you for capital gains taxes, and you can't put that into other accounts. Obviously, it has to be a tax.
Absolutely. All right, if retiring early and having enough cash to have several years of very low taxable income, it seems like Roth conversions are a no-brainer. But when we hit 59 and a half, would another consideration be taking some 401k IRA withdrawals to lessen the RMDs down the road versus only doing conversions? Possibly. It depends. Yeah. I think it's a really good question and sounds like a great situation to be in. But at the end of the day, I think we would need a little bit more detail to answer that with some certainty. I think to your point, the Roth conversions are probably a no-brainer. And then from that point, you've got to kind of start to understand, what are the other accounts and where those funds are going to come from.
I think it's a big tax question too of, they're retiring that early, which is awesome. We wish clients retired that early. But then we have this gap between 60, 65 for Medicare, right? So what are our Medicare costs? What if we have higher income? Do our Medicare costs or do our Medigap, does that go up in cost because our income is X? Or do we pull from this account to lower that to make our coverage cost less? So there's a lot of moving pieces with those. And we love those situations where people retire early. There's a lots of problem solving going on with conversions, Medigap coverage, subsidizing their income to lower their health care costs through Affordable Care Act. So a lot of different things to go into to really help the situation out there.
Absolutely.
Yeah. Any more questions, Skylar?
I got one more.
We have one more question here. One more question.
All right. Will Lifeworks develop an overall planning strategy at a cost, and will that cost be waived if the decision is made to sign on with Lifeworks? I'm going to let you take that. Yeah.
Sure. So the way we work is we lead with financial planning. What we understand, though, is that life isn't static, it always changes.
Right.
So for us to do real work for financial planning, we continually charge for financial planning, and we have different packages for this. It ranges from 100 for a family up to 300, all depending on the complexities of the situation. All right, so if you have 8 rental properties, you're still working, you have this legacy account, this massive multi-tiered trust, it might be $300 a month for financial planning. And if you're at that level, we might include some work for trust and estate. We might include tax returns, right? We might include some things like that depending on the situation that goes into that cost. So that fee for planning, we feel that we're really open, upfront, honest about our costs. And if we're showing you value and charging you for financial planning, always, that means we're always going to put in work to this because we have to show you value. If you became a asset client for assets under management, we charge 0.8%. But that scale for financial planning can be moved depending on the complexities of what we do. And with our tax planning, that's one tier of it. The first 4 to 6 weeks that we do dive in for our clients is pretty labor intensive, right? So a lot of the work is on us to show value. And if we don't, what's really good about this, or good for you, should I say, is if we don't do a good job, Chris and I don't do a good job, our team doesn't do a good job of our CFPs and CPA we have on staff, then you can cut ties and say this isn't worth it. But it's on us to show you that we're giving you value with really in-depth financial planning that links conversions, donor advised funds, distribution strategies, right? Everything else in between, right? To make sure we're doing that. So it's on us to show that. So we don't waive that. It could drop down a little bit, all depending on, again, a agreed upon value or cost that you enter with us to do financial planning.
Yeah,
all right?
absolutely.
So down below, again, our offer, set some time with us. See if you need help with buttoning up your strategies, linking together what matters most to you to these financial planning things such as conversions, good tax strategies, Social Security timing, distribution strategies. If you feel like the grasp isn't there, you want more help, book some time with us. It's low barrier of entry. There's no cost to you for this. It's just come talk to us. Scroll down beneath, go down below. Chris's calendar is down there to talk to you about what we can do and kind of hear more about your 30,000 foot view. Where are you at right now? Where do you want to be? Do you think you need help? And we can see if you need help with that phone call, right?
Absolutely.
Yep, that could be a virtual call. That could be a regular phone call. We prefer the virtual call if you can because it is a more personal approach, right, of what we do and how we do it. But if you want to, please scroll on down, book some time with Lifeworks, Chris, and our team to see if we can help you out with some good financial planning.
Yeah, absolutely.
All right.